Growing demand in the commercial construction sector has helped to offset any declines that we've seen in the residential construction area. But this growth will continue to weaken in 2008 as we see tighter underwriting guidelines in the capital markets. Reductions in the Fed rate, which is the rate charged by banks to each other for overnight loans, and recent infusions by the Feds through the acceptance of a broader base of collateral from commercial banks in exchange for short-term loans will continue to inject liquidity into our market, but neither of those moves will continue to be a silver bullet solution in 2008. Declines in housing will continue to impact GDP in 2008, but the impact is causing less of an effect to growth. Let me say that again. The impact of housing in 2008 is causing less of an impact to economic growth. You know, historically, housing has contributed 3 to 6% to GDP, which is relatively small when you compare that to consumption, which contributes about 70% to GDP. Declines in residential construction have been severe, with results being off by double digits, and these declines will remain large throughout 2008. But as the declines represent a smaller base, the impact to GDP will obviously lessen. Many of the foreclosures that we see in the media right now, we have to recognize there was about 2 million defaults last year in 2007. They think that number is going to continue to rise in 2008. But what we have to realize is that a fair number of those defaults and a fair number of those foreclosures, first of all, are not concentrated in North Carolina. And a lot of us have realized that. About 25% of those defaults are concentrated in California and other markets in the West Coast. But the other thing that you have to consider is a lot of those defaults are actually flippers or speculators. People that had bought houses and they were going to flip them back out into the market, but the market shifted too quickly in order to allow them to do that, so they then had a default or a foreclosure. You know, the proposal by the Bush administration to freeze rates on residential loans will only just put off this what I call a cleansing of the market. And you're hearing a lot of talk about freezing rates, or you're hearing a lot of talk about putting a moratorium on foreclosures and those kind of things. But all that will do is just forestall the cleansing that we need to see in our market. Our ability to avoid recession will greatly depend on the strength of the consumer to weather storms in housing, rising energy costs, tighter credit, and a slowing job market. In December of 2007, the market reported a rise in unemployment to 5%, and consumer confidence is now off by 10 basis points. These 2 points indicate to us that future weakness in consumption will occur. And as I mentioned before, consumption contributes about 70% to our GDP. In 2007, we recorded growing weakness in the earnings of the companies that comprise the broad-based S&P 500, and weakness in earnings will result in less growth in employment and flat to negative wage and salary growth. Now that last point I just made is an important one, and I'll shed a little light there. You know, when I say there's going to be less growth in employment, that's one issue. But flat to negative wage and salary growth is a big issue. Mm-hmm. And the reason why is because it's commonly mistaken that consumption goes with the direction of asset prices. So as stock prices balloon, as stock prices balloon, or as housing prices balloon, people tend to consume more. Well, that's a common misconception. It is a part of it. It does play a factor in it. But consumption really goes more with wage and salary growth more than anything. So as wage and salary growth starts to constrict, that's where we're going to have some problems with looking at a possible recession. You know, currently, and I didn't check it this morning, and essentially what I'm going off of, I prepare a briefing report every year for our clients. But essentially what I'm going off of is that briefing report right now. But currently the 10-year Treasury yield has been trading at around 3.5 or 3.6%, which gives us a good indication of the market sentiments towards long-term interest rates going forward. Our estimation is the Fed will cut rates maybe no more than another 100 basis points in the first half of 2008 to prevent a full-blown recession. And I feel like we're even giving ourselves a little padding there. You know, most markets right now, most people in the market are saying that the Fed rate probably won't get lowered at about 2.5%. Right now it's at 3%. The rise in interest rates during the second half of the year will allow our treasuries to once again achieve popularity, as foreign governments will be lowering their interest rates to combat slow growth in their economies. As fears of risk starts to leave the market, we estimate the spreads on CMBS loans will begin to narrow throughout the second half of 2008, and conduits will begin to return to the market as a dominant source of permanent mortgages. And that's important because the thing you have to keep in mind, we had a number of portfolio deals that were getting done in the market, deals that were $100 million and greater. Well, your commercial banks and your insurance companies don't have the capacity to take on that many of those size deals. So you need the conduit world in order to take on those size loans. So the conduits will return to the market, but it will be 2009 before we'll see any return of the conduits to the capital markets. The proposal by the Bush administration to freeze interest rates on residential loans will also have an impact on investor sentiment towards CMBS bonds. You know, often some of the collateral pool making up CDOs will include CMBS bonds in addition to the subprime mortgages that were securing those structures. So investors may realize a loss of returns as a result of those freeze in interest rates. And if investors are not able to realize their stated returns, they will feel there is no need to purchase the securities and begin to feel that the fixed income portion of their portfolios will perform better through holding treasuries versus holding CMBS bonds. Foreign investors will be incentivized in 2008 to purchase physical assets in the United States as a result of the weakness that we have in our currency market. So some of our real assets like office buildings, industrial properties, apartment buildings, they're now becoming more popular to foreign countries again because our currency is so weak. So you know, you take a dollar and you exchange it for a euro, you're going to get about $1.40 or $1.50 in euros. I mean, or it takes about $1.40, $1.50 in US dollars to get 1 euro. So that makes our currency look very cheap if these guys want to come over and buy assets in our country. And even just recently, there was a German group, I don't know how many of you guys heard about this, there was a German group here in Winston-Salem that was looking for office buildings in downtown. There was also an Israeli group that came to Greensboro, and they're looking for buildings over in Greensboro. Markets like Raleigh and Charlotte, where they have more Class A real estate, they're really going to benefit from that because those are the types of assets that those investors are looking for. They're looking for Class A office property or Class A retail space, those types of things. So markets like Charlotte and Raleigh should see a lot of attention from that. These new trends of direct foreign investment, along with continued demand from institutional investors such as REITs and private equity funds that continue to have high allocations to real estate, will continue the trend of an individual investors searching out value-add opportunities amongst Class B and Class C real estate. So what we feel like is most individual investors will continue to look at your Class B, Class C properties. They'll continue to look for opportunities where they can add value. Redo a parking lot, manage a property with better operational skills, or redo the roof, or put new tenants on the property. Those are the kind of opportunities that individual investors are going to continue to look for in 2008. You know, we often hear a comparison drawn between our current real estate market and the crisis caused in commercial real estate during the savings and loan crisis of the 80s. But this comparison is highly overblown due to the fact that we did not experience the same level of overbuilding that was done in the 80s. You know, our issue today results from easy credit and over-leveraging. And those issues can be worked out a lot easier than overcapacity or basically buildings sitting vacant on the market. You know, as a result of the tightening in the capital markets for permanent loans, which typically provide an exit strategy for some of the construction loans that our banks originate, this tightening will prevent any overbuilding of speculative commercial real estate, but will also cause a reduction in the recent boom of commercial construction that we've seen over the past several years. So we do think commercial construction is going to slow down tremendously. And we've already been hearing that from a number of banks. So we don't think as many properties are going to be built during our current cycle. But that'll all start to switch back around once our CMBS lenders get back in the market in 2009.